After the global financial crisis, investors turned their backs on emerging markets, and yet fast forward a couple of decades and those markets are resetting for a variety of reasons. Greater dispersion in equity valuations, shifts in interest rates, geopolitical shocks and unpredictable business cycles. As a result, in short, EM is back in focus. To discuss that renewed focus and explore the persistent gulf between investor perception and reality, I'm joined today by two senior managers from UBS Asset Management. Shamaila Khan is the head of Global Emerging Markets and Asia Pacific Fixed Income, and Max Castelli is head of Global Sovereign Market Strategy and Advice. Shamaila, Max, thank you so much for being here.
Hello.
Hi.
Shamaila, let me just ask you, starting with the concept of the change we're talking about in emerging markets, how has it evolved in recent years, would you say?
I think it's also useful to just start off defining emerging markets because it's often referred to as a homogeneous sector, which is actually not true. If you invest in EM equities, you get very different risk versus investing in EM hard currency debt versus investing in EM local currency debt. So EM equity index is basically 80% invested in 5 countries. It's extremely concentrated. Whereas if you buy EM hard currency sovereign and corporate debt, and by hard currency I really mean dollar-denominated debt issued by countries and companies, you can invest in 80 countries. No one country is going to be more than 7%, and it's extremely diversified from a regional perspective. So it's very different risk, and even EM local currency debt is more concentrated than EM hard currency. It's about 20 countries or so you can invest in. So therefore, it's important to understand the distinction of investing in emerging markets. And if you look at the historical performance of EM hard currency, sovereign and corporate debt, has actually outperformed similarly rated debt in the US since 2003, which is something that most investors don't realize. Because EM local currency debt and EM equities underperformed. But EM hard currency debt has actually had very steady performance. And that is something that investors are now just realizing, the resilience of emerging markets in the hard currency space.
Max, why do you think investors aren't necessarily, all of them at least, keeping up with those kinds of changes?
I think three main factors, I would say. First of all, we have a macroeconomic story. If you look at the performance of emerging markets over the last few years, the word which is more often used is resilience. Resilience to shocks, geopolitical events, but also resilience, for instance, to events which in previous decades would have been very bad for them. Just to give you an example, if you take, for instance, COVID, with the massive rise in US dollar and US interest rates, many emerging markets probably would have gone into a crisis. This time around, apart from very few cases which were more specific, actually emerging markets have been holding up pretty well. And we had another example of resilience in the recent months with the conflict in Iran. So there is a macroeconomic story, and we can go and deep dive more about which factors are supporting this macroeconomic story. The second one is that there is a very dynamic and innovative corporate sector. It is not just about the US. If you go in countries like China, Taiwan, Korea, and also in some Latin American countries, there are corporations which are doing very well, which can offer value to investors. And the third factor, I believe it is something more recent, let's say, but there is definitely a demand for investors to diversify more away from the US. I mean, there is no doubt the US equity market has been the star performer over the last few years. They outperform. But there are concerns about the valuation in the US. There are concerns about whether all this massive investment in AI will in the end deliver profit. And you can also diversify the AI team outside of the US. And we can, again, discuss more in detail which country, for instance, are part of the broader AI story outside of the US, which is the dominant economy and the dominant country in the AI revolution.
I do want to unpack some of that in a moment, but Shamaila, when you have this kind of change in the risk profile around EM, do you believe there's a clear reason why investors maybe don't recognize that change?
There's definitely a huge gap between perception and reality. There is a sense that EM countries are more risky because they have higher debt levels, which is actually not true, because if you look at the aggregate government debt of emerging market countries, it's substantially lower than developed market debt. So it's about 70% versus 110% for developed market countries. And then there has also been concerns about EM because China's been slowing down. The reality is that growth in emerging market countries has been fairly stable, around 4% for the last few years, and on a sustained basis, a couple of percentage higher than developed markets. So on the debt and growth side, very stable, contrary to perception. But more importantly, over the last few years, just as Max was saying, the resilience has come from implementing structural reforms, more credible monetary policies. They were actually quicker to hike after COVID, and therefore inflation came down more dramatically in EM than DM. And these factors have not been ignored by rating agencies. The upgrade-downgrade ratio in emerging market countries has been among the most favorable over the last couple of years versus a decade. And defaults in EM countries have been zero since the end of 2023. And this improvement is not restricted just to sovereigns, corporates, particularly the high-rated companies, have been deleveraging, and default rates have been going down there as well. So these fundamental improvements have really contributed to the resilience, but it's not just fundamentals because technicals have contributed as well. Supply in emerging market hard currency debt has been very low compared to global fixed income sectors. And in fact, EM companies have been reducing external debt, so it was negative for several years until last year. And demand has significantly picked up since last year for emerging market debt. And this is when investors have entered 2025 with very low exposures to EM debt, because there were 3 years of outflows between 22 and 24. So we think that in order to even get back to levels of exposure in 2021, which were very low to start with, it's going to take several years of inflows to achieve that. And as Max said, investors are looking to diversify. So 2021 levels are not enough. They have to significantly increase exposure. So these positive fundamentals and technicals have led to the resilience that we've experienced in emerging markets, even during times of conflict like the Middle East, or even last year when there was concerns of trade war.
And Max, those fundamental changes, you can call them regime changes in some ways, do they apply equally to equities as to fixed income?
I think so, because, as I said, we talk about regime shift here, and actually this is very interesting. Very often investors do not pick up the regime shift immediately. Maybe the regime shift is already happening, but investor needs time to understand that the things have changed, and we have so many examples of that. For instance, when we talk about the new geopolitical context, very often we say that it is a new regime, but if you look at the behavior of investors, it's not really changed very much. There is still dominance of US assets. They still invest with the same paradigm. So we believe that there is a need for a shift of this paradigm to start considering emerging market not as one block, but definitely as an area where you can find a lot of opportunities. In terms of regime, what does it mean, a new regime? A new regime is, we talk about resilience. This resilience is fundamentally about monetary policy and fiscal policy. And already Shamaila alluded to that by having a very robust monetary policy framework, independence of central banks, inflation targeting, on the fiscal side, prudence, relatively low level of debt. Probably for a simple reason that the emerging market already suffered crisis in the past and they learned the lessons. They don't want to find themselves again under stress because, for instance, of unsustainable debt level. I was actually talking about that. I was coming back before being in New York. I was in Peru for a conference organized by the Central Bank of Peru. And there were all the governors of Latin America. And I was impressed how they were talking about what they've achieved in terms of stability. And actually their main question was not really, oh, we have a problem, but how to maintain that stability, mainly because of the external factor, which, as you know, are very volatile. We live in a more volatile world, and they need to protect themselves. But coming back to your question, it is about fixed income, it is about equity. Of course, these are two separate asset classes which serve different needs. For instance, I work with central banks, a reserve manager. These are largely fixed income investors. You will be surprised how little it is still the exposure of a reserve manager to, for instance, hard emerging market debt in hard currency. And I always ask myself, you prefer to buy US equity, a very high valuation, which maybe deliver a return of 6-7%, but with the risk of a significant drawdown, and instead you're not buying investment grade rated hard currency denominated bond, which can deliver return of 7-8% in good years. There is this inconsistency in the way they look at the emerging market, but I think this gap will gradually close because the world has already changed. The fundamental factor of change, and now it's time for the investor to change their mindset and start considering emerging market in a different way.
So to put you on the spot a little bit, if you're talking about all these opportunities, where are the growth areas that investors should be watching?
From an emerging market point of view, it depends very much on the type of investor. An investor who wants to diversify, for instance, a US Treasury or advanced economy bonds, they definitely have a very good pool of assets from investment grade in the sovereign space and also some very good corporates in the fixed income space. The advantage is not just the pickup in return, but it is as well to have a diversification in your global fixed income portfolio. On the equity side, it's also very interesting in the sense that, first of all, there is the question of which countries are more interesting from a potential point of view. Here, AI is dominant. If you look at two countries, Taiwan and Korea, these are countries which are fundamentally, they are the provider of the manufacturing goods on which AI works. So basically the chips, the semiconductor, etc. And in fact, if you look at the performance of the last few years, has been pretty stellar. And do you know what is the interesting thing? Then you look at the PE ratio of these countries. They are still a 9, 10, and then after 500% increase. And then you compare to the US, where instead we have stocks which have a PE ratio of 40, 50, but so the potential is there, and it's incredibly interesting. But there are, as I said, I think Shamaila raised a very good point. This is not an homogeneous group. These are different countries with different drivers. Think about, there are countries who are surfing the AI revolution like Taiwan and Korea. There are countries who are part of the reconfiguration of the global supply chain. Just think about Vietnam or even India and there are countries who are also benefiting from the commodity price cycle. Think about countries in this part of the world, in America, like Chile. So there are different drivers. So what I would recommend investors is that this is not a block. Look at each individual countries, look which driver is behind their performance, and then of course invest according to your risk and return preference.
And Shamaila, in your space, when you're looking at fixed income opportunities, does that kind of mirror what Max is talking about in terms of where to be spending time researching and thinking about deployment?
Yeah, absolutely. I mean, look, I mentioned EM hard currency, sovereign and corporate debt has outperformed similarly rated US debt since 2003 and over the last few years as well. So that has happened at a time when there was US exceptionalism, the dollar was appreciating, and rates were rising. So what we are trying to explain to investors is this should be a structural part of your portfolio, because if it could outperform when all the headwinds were against emerging markets, it's likely to keep outperforming. So that's something that we believe investors should think of, not as a tactical allocation. On EM local currency debt, I have to say that earlier this year, unlike most of my peers, I was saying you have to be a little bit cautious, because even if you have the next 3 to 5 years of dollar depreciation, you can easily have small periods of dollar appreciating, and the market wasn't positioned for it. There, we do believe you have to be a bit more tactical. It's a relatively more concentrated space from a country exposure perspective. And so there, that's sort of a different kind of risk.
A bit more nimble you need to be.
Exactly.
Yeah, on that, maybe on this.
US dollar, there is an interesting story, because I think Shamaila is absolutely right. If you think about 2025, we were all more or less thinking about dollar weakness. Nothing dramatic, but the consensus was for the dollar to weaken, which is positive for emerging market. Then we have the conflict in Iran, and this, of course, mix a little bit the cards. Suddenly, the dollar, which after Liberation Day last year was almost doomed to lose the safe haven status, is back, and actually is back a big way, from that point of view at least. So now I see that investors are becoming much more, they make a distinction between dollar, the currency, and the US Treasury market. So these are two different things. You can have a positive view about the dollar, in the sense I see the dollar strengthening, but you still may have concern about the US Treasury in terms of debt sustainability or the impact of policy. Think about the midterm election coming up. Who knows what could happen around the fiscal policy. So this is something very important. So I think we have to distinguish between the two. Sometimes before they were put together as part of the same story. It might be a different story depending on how the US policy develop in the future.
And Shamaila, you've talked about kind of potential for growth, for outperformance in both EM, dollar-denominated and local currency-denominated options. And I just wonder whether you think that, looking ahead over the next 3 to 5 years, that diversification is something that investors need to think about as well as performance.
I think investors really are starting to think about diversification. Just as Max said, there are no clear safe havens anymore. And I've been on a number of panels and investor forums, and the one theme that is recurring is the need for diversification. And that is also shifting in terms of how investors define diversification, because historically, they were diversified by investing in different sectors. We'll do private credit, we'll do private equities. But at the end of the day, they're buying the same countries. So geographical diversification is becoming more and more important. So we do think that's going to be a focus. And the reality is, for example, when you buy EM hard currency debt, about a third of the index is frontier countries. The only way you can get exposure to these countries is buying the hard currency sovereign universe, because they don't have liquid equity markets. Some of them don't have liquid local markets. These countries have returned, many of them, between 30 to 300% over the last few years. And they've had AI-like returns, but no correlation to AI. They're completely idiosyncratic. So that's really giving you very different kind of alpha. Asia high yield credit is another area which we've liked, where it's still cheap relative to historical level. Default rates are going down at very low levels and still offers you very attractive high single-digit yields. And these are the diversification opportunities which investors should be considering.
Generally speaking, the conversation about US concentration risk is on the agenda of any investor today, regardless of where you are in the risk-return spectrum. It can be a fixed income story, it can be an equity story, and can be an alternative asset class story. Our view is very simple, and that's also the view that I discuss with clients. There is a belief that we are in the middle of a massive technological revolution, which has the potential to be transformational. I think this belief is very strong, and there's not been valuation in the hyperscaler has not yet dented this belief. However, diversification in investing matters. So if you are a global investor, the type of investor I have, they have a sort of a global portfolio. And then when you look at your portfolio and you look across fixed income, across equity, across alternative, and you realize that maybe you are exposed to US assets for 70% of the total. Our recommendation is remain exposed to the US, because the US is the leading country in the AI revolution, but diversify more. So there is a question really of US concentration risk diversification. There is a second risk, which is more related to the new global regime we are in, which is the search for diversifier. In the sense that we live in an era that probably is going to be characterized by relatively high inflation rate rather than lower inflation rate. Normally, when you have an inflation rate a little bit higher, you tend to have a positive correlation between fixed income and equity. So it becomes very important to think about how do I search, I need a new source of diversification. Think about, that's why, for instance, gold has been doing so well in the last 2 years, because gold provides that type of diversification. It is possible to have more diversification even within fixed income and equity by looking at other markets. And I think emerging market, think about China fixed income, for instance, can provide also source of diversification from an asset allocation perspective.
I guess my question would be, you're making recommendations to people to think about diversification because of the changes in geopolitics, supply chains, all of these macro factors. You're talking about trying to avoid too much US or AI exposure potentially.
It's not avoiding, it's a diversifying.
Diversifying away from. So you have opportunities elsewhere. And I guess the question is, do you think that people will take that advice on board and stick with it over the long term, as opposed to just flirting with the idea now?
I think they will, for two reasons. First of all, because it is pretty obvious that the outperformance of the US cannot last forever. I don't know when, but eventually there will be a slowdown in terms, for instance, of the big investment cycle of the hyperscaler in the US. The return on the equity in the US will be lower. So there will be definitely a moment where this will become visible as well in the performance of different assets. But as I said, I think investors are already at this stage. I talk a lot about rotation. You can already see that. What happened is that it was already ongoing in 2025. If you look at emerging market equity, emerging market fixed income, they have been doing very well and they outperform the US. Then we have this geopolitical event, which in some way I would say it is like when you press the pause button for a moment. But I think this is a trend that will continue eventually over the medium long term. And I see more rotation and more spread of investment of which emerging market will benefit.
Are you, Shamaila, similarly optimistic about that long-term investor sentiment when it comes to EM opportunities?
Yeah, absolutely. So it was interesting. With the Middle East conflict, EM hard currency debt outperformed similarly rated US debt throughout the conflict. Last year, with all the concerns around trade war, EM outperformed when the market was going down, and when the market recovered, it outperformed again. So investors are really paying attention to how emerging market is performing, not only in up markets, but also in periods of risk off. And that is leading sort of a recalibration of the view of how much EM they should have in their portfolios. The larger investors, I would say, have always had somewhat of a structural allocation to EM, but it's very small. EM is more than half of global GDP. It's more than 80% of global growth. But at best, single digits, I would say, max in large investors' portfolios. They are recalibrating how much EM they should have as an overall asset allocation. But we're seeing interest across the globe in other channels as well: wholesale, ultra-high net worth, family offices, wealth management. So it is very much a universal interest in emerging market debt. And we do think it's sort of moving towards a direction where it's more of a structural allocation than people thinking, oh, let's just add to it tactically for now.
I want to thank you both so much, Shamaila, Max. Really interesting conversation, a lot of things to think about.
Thank you very much.
Thank you.
That was a very clear explanation of how emerging markets can offer investors some of that ever crucial diversification, not to mention opportunities in some of the more exciting new growth sectors. You've been listening to The Red Thread, a podcast series in partnership with custom content from the Wall Street Journal and UBS. I've been your host, Willem Marks. Join us for more episodes at partners.wsj.com/UBS, and be sure to subscribe on Spotify and Apple Podcasts. The content in this podcast was relevant when it was published. Current views may differ.